Welcome back to the Daily Crypto Report, the place where we break down complex financial topics so you can make smarter decisions with your money. In today's video, we're diving into the fascinating world of Bitcoin-backed loans. If you're curious about how they work, how they differ from traditional loans, and why they're becoming so popular, you've come to the right place. So grab a coffee and let's get started. First, let's start with the basics. What is a Bitcoin-backed loan? Simply put, it's a type of loan where Bitcoin is used as collateral. This means you pledge your Bitcoin holdings to a lender in exchange for a loan in fiat currency like USD or EUR, or sometimes even stablecoins like USDT or USDC. Think of it as borrowing money against the value of your Bitcoin without selling it outright. Why would someone want to do this? Well, there are a few reasons. If you believe Bitcoin's value will increase over time, you might not want to sell your holdings. By using it as collateral, you can access liquidity without giving up your Bitcoin. This can be particularly useful for covering short-term expenses or making investments while still holding on to your crypto assets. Now let's compare Bitcoin-backed loans to traditional loans. In a traditional loan, lenders often require a good credit score, a stable income, and sometimes even a cosigner. With Bitcoin-backed loans, the primary requirement is owning Bitcoin. There's no need for a credit check because the loan is secured by the value of your Bitcoin. Another major difference is how interest rates are determined. In traditional loans, your interest rate depends on factors like your creditworthiness and the type of loan. For Bitcoin-backed loans, the interest rate is usually fixed and depends on the loan-to-value ratio, or LTV. For example, if you borrow 50% of the value of your Bitcoin, you might get a lower interest rate than if you borrow 70% of its value. One important thing to note is the risk of liquidation. With Bitcoin-backed loans, if the value of Bitcoin drops significantly and your collateral falls below the required threshold, the lender might sell your Bitcoin to recover the loan. This is different from traditional loans, where missing payments affects your credit score, but doesn't involve liquidating assets directly. So how popular are Bitcoin-backed loans? Over the past few years, they've gained significant traction, especially among crypto enthusiasts and investors. You must be very careful, though, because several big companies offered Bitcoin-backed loans in the past, like BlockFi and Celsius Network. The growing popularity can be attributed to a few factors. First, as Bitcoin adoption increases, more people are holding significant amounts of the cryptocurrency. Many of these holders see Bitcoin as a long-term investment and prefer not to sell it, making Bitcoin-backed loans an attractive option. Second, the rise of decentralized finance, or DeFi, has introduced decentralized lending platforms like Aave and Compound, where you can also use Bitcoin and other cryptocurrencies as collateral. Now let's talk about the pros and cons of Bitcoin-backed loans. Starting with the pros, no credit checks. As we mentioned earlier, Bitcoin-backed loans don't require a credit check, making them accessible to people who might not qualify for traditional loans. Quick approval. Since the loan is secured by your Bitcoin, the approval process is usually faster than that of traditional loans. Liquidity without selling. You can access cash without having to sell your Bitcoin, which is great if you believe its value will grow in the future. Potential tax advantages. In some cases, using Bitcoin as collateral may help you avoid triggering a taxable event, which would happen if you sold your Bitcoin. But, of course, there are cons as well. Price volatility. Bitcoin's value can be highly volatile. A sudden drop in price could lead to liquidation of your collateral. Interest rates. While competitive, the interest rates on Bitcoin-backed loans can still be higher than those on secured traditional loans, like home equity loans. Limited use cases. Not all lenders accept Bitcoin as collateral, and the platforms that do may have restrictions on the types of loans or fiat currencies they offer. Regulatory uncertainty. The crypto space is still evolving, and regulatory changes could impact how these loans operate in the future. So who should consider a Bitcoin-backed loan? These loans are ideal for people who are crypto-rich but cash-poor, and need liquidity for short-term needs without wanting to sell their Bitcoin. They're also a good option for investors who believe in Bitcoin's long-term potential and want to leverage their holdings without cashing out. However, it's important to be cautious. Make sure you fully understand the risks, especially around liquidation, and only borrow what you can afford to repay. Additionally, take time to research the platform you're using. Look for transparent terms, strong security measures, and positive reviews from other users. Before we wrap up, let's cover some additional tips and facts about Bitcoin-backed loans. Diversify collateral. Some platforms allow you to use other cryptocurrencies alongside Bitcoin to diversify your collateral and reduce risk. Loan-to-value ratio. Be mindful of the LTV ratio you choose. A lower LTV ratio reduces the risk of liquidation, but may limit the amount you can borrow. Repayment terms. Understand the repayment terms clearly. Some platforms offer flexible terms, while others may require fixed monthly payments. DeFi versus CeFi. Decide whether you want to use a centralized platform like BlockFi or a decentralized platform like Aave. Each has its pros and cons in terms of control, transparency, and ease of use. And finally, always remember that the crypto market is unpredictable. While Bitcoin-backed loans can be a useful financial tool, they're not without risks. Approach them with a clear strategy and make sure they align with your overall financial goals. That's it for today's video on Bitcoin-backed loans. I hope this gave you a better understanding of how they work and whether they might be right for you. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an update. And if you have any questions or thoughts, drop them in the comments below. Thanks for watching, and I'll see you in the next one. Until then, stay informed and stay financially savvy.